I think we're in wild times. So I think there's some great opportunity in gold. I think there's potential for it to have a pullback to 3,600 still. Maybe this even happens over the next month or two, and then it rocket higher. But if gold holds these lows, this low that it put in over the past week, and starts to head higher, then we're probably going to 8,600. So this is the very critical level for silver. Silver really needs to hold 60 or like $61 per ounce. If it can hold that, the long-term bullish picture is pointing to more or less $75 silver, which would bring silver up to about 175, a very big gain from where it is. But if silver breaks 61 or $60 per ounce, we're probably going to see a very quick drop down into this $40 mark, which is a 40% haircut from where it is. So, I mean, either way, there's a big opportunity.
Gold and silver are at a fragile turning point, where short-term weakness is testing investors while the larger cycle still points to a major opportunity. The market is not giving a simple signal, because downside risk and long-term upside are both present at the same time. The next move could define whether this is a breakdown or the final reset before strength returns. Chris Vermeulen, a technical market strategist known for trend following, Fibonacci analysis, and risk-based market timing, argues that recent price swings should be viewed in the context of a larger long-term trend. The focus is on whether gold can hold its recent lows after a sharp pullback. If the metal breaks down, a move toward $3,600 could happen quickly, and that would shake out late buyers who entered during the euphoric run. But if gold holds support and turns higher, the next major rally could aim toward $8,600. That makes the current zone important, because it may decide whether metals reset lower first or begin building the launchpad for a much larger move ahead soon for patient metals investors. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
This is the daily chart of gold. Let's just zoom back. As you can see here, we did have that precipitous waterfall really started to, I think, test investors and precious metal holders of what is going on, and is gold going to break down and sell off in a big way? If we look at gold and just kind of look at these recent lows, we've got a lot of consolidation through here from late 2025. And then we had a wick low over here where we got into a huge waterfall sell-off, volume ramped up, and then we tested this low just about a week ago. And so this is a very big test. Now there's a couple of scenarios here. Obviously, right now gold is in a downtrend from a short-term standpoint. So as a short-term trader, gold is making a series of lower highs, it's making a series of lower lows, and it actually is still pointing to lower pricing. Now, the flip side of that, as a long-term investor, the long-term trend is actually bullish. We've got a very strong uptrend. It's consolidating, meaning it's pulling back in somewhat of a controlled manner, building what could be a launch pad, a bull flag pattern pointing to higher pricing. And so depending what gold does here, and silver is very much similar, there's a very big move pending. And so if we were to look at the bullish and this scenario for gold at this point, let's just go back to the ultimate kind of low that we saw back early in 2025. We saw the low in gold. I love to use a Fibonacci extension. This is based on Fibonacci theory, which is pretty much how the whole universe, the world, everything seems to function. Based on Fibonacci theory telling us the strength of a move to the upside, and then you can figure out how strong or how much the market pulled back to the downside. It tells us where the market naturally is going to want to go. So from a long-term super cycle of bull market in gold, if gold can hold these levels, we are going to see gold on the next major rally go up to about $8,600, which is pretty darn exciting. That is where this whole super cycle in gold is pointing to. One big final euphoric move. Probably something in the world is going to fall apart. Who knows? But there'll probably be a reason for gold rocketing up there at that point. Now, the flip side of that we need to be aware of is also the downside potential, which let's go and zoom in on this. This is what people need to be aware of. The downside potential using Fibonacci based on the most recent sell-off and the bounce that we've had. This tells us where the downside target is for gold. And that level here is about 3,600. So from where gold is right now, Elijah, we could see gold potentially take about a 15% haircut to that level, and that would actually be a bullish signal long term. A long term investor, if we see gold and silver come down to 36, this brings us back to a very unique situation, which is right before we saw gold and silver go into that euphoric kind of parabolic move late last year and early this year. And so the market is very efficient. Whoever got in late, if you weren't in metals and you got sucked into this excitement and you bought up here, the market is likely going to test you. It's going to try to shake you out and come back down and put you underwater or put you back to break even and make you want to get out of it. And then it will take off without you. And so the market is, based on the analysis here, is pointing to it. That's where it wants to naturally go. So I think there's some great opportunity in gold. I think there's potential for it to have a pullback to 3,600 still. Maybe this even happens over the next month or two, and then it could rocket higher. But if gold holds these lows, this low that it put in over the past week, and starts to head higher, then we're probably going to 8,600. And there's actually a really interesting chart. If we go back and look at the weekly chart of the S&P 500. So this candlestick chart in the background, red and green, that's the S&P 500 weekly chart. The yellow line is the chart of gold. And what I want to show here is we're kind of going into this phase. The stock market is starting to ramp up. And I think we might have this one more big euphoric kind of move in the stock market, which is going to be like the AI bubble kind of blowing off. Everybody finally piling in who's not in yet, creates a strong move up in the stock market. And this yellow line here is gold. Money's been moving out of gold into stocks. And so gold's been pulling back. And so where I think we are right now in this gold and stock market kind of scenario, I think is actually very similar to what happened over here and where we are in the stock market back in 2007. So let's go back and take a look at what happened back then. If we were to overlay these scenarios, we are in this point here where gold has just pulled back. If we were to think of where we are today, a very sharp pullback. The stock market is pushing higher. We just had a bit of a correction over the past couple of weeks with the stock market. And now the stock market wants to push higher with one last big push. And this was the stock market top before the stock market crashed like 55% almost. What we're looking for now is if gold holds these lows. So if we were thinking of this was today's chart, gold put in these two lows and gold is technically trading like right here. If gold holds these lows where we are right now, it's equivalent to this chart where gold will start to turn up. It will kick back into an uptrend from both a short-term trader and a long-term investor standpoint. And then gold shoots higher to 8,600. The stock market moves up more so first. I think we're still going to see people move into the stock market. Gold will build a base. As the stock market starts to get choppy, money starts to rotate for gold for safety, and then we see a big move to the upside. So that is a really interesting scenario and what could happen before we go off this huge financial reset, which who knows what the trigger will be, what we'll call the financial reset after. We never name it until it's broken, until everybody throws a label on it. But if we were to look at this chart going forward, I can't really squish this gold chart down at this point, I don't think. Let me just see if I can. If we were to squish this chart down, we could see the stock market continue to push up here and then start to get into some volatile market conditions. Gold will start to stabilize and start to turn up. And as the stock market starts to break down and sell off in a big way, we see gold shoot up to that 8,600. So it's a really interesting scenario how this could unfold. And I can feel the tension in the air. I can feel the bubble, the euphoric move with the AI space. Because it's so big, Elijah, it's really dragging the whole market up. And I have the same feeling of what happened earlier this year with precious metals. You could feel the energy, the excitement, the euphoric, but the precious metal space is very tiny. When it comes to AI, it's the whole world. It's every person, every kid, every grandparent is interested in this. So this is not like, this has got a lot more power. This is a big train that's going to be difficult to slow down. I do think it's starting to slow down a little bit. I think we're starting to get people are really piling in, and it's just a matter of time when it runs out. But that's the scenario that I see unfolding. This is the bullish case. We see stocks muscle higher for another couple of months. The precious metals hold their ground, and then we eventually see the precious metals have that one big euphoric the next big euphoric blow-off phase before we see a bigger correction. So, I know I covered a lot there, but that's the scenario that we need to be aware of, is those two for gold, and silver's, kind of follows suit.
The stock market adds another layer to the metals outlook. Money has been moving out of gold and into equities, especially as the AI trade continues pulling investors into one final euphoric push. That setup looks similar to earlier moments when stocks kept rising while gold quietly rose before becoming the safety trade. If equities continue higher for a few more months, metals may stay choppy or even drift lower while investors chase momentum elsewhere. But once stock market volatility returns, capital could rotate back toward gold for protection. The important point is that metal weakness does not automatically mean the long-term story has failed. It may simply mean the market is regrouping after a blow-off move, while another speculative bubble reaches its final stage and prepares the next rotation into safety and real assets again over the coming months. Now, let's get back to the interview.
Silver is quite a bit the same. It's dipped down into this support level, these lows. It's had a technical bounce, and it is pointing to lower pricing. And when we look at silver and use the Fibonacci price pattern, silver had its initial drop, and then it's had its bounce, and it's working through this whole level. Now, there's some interesting levels here on silver. If we take a look, there's this 618 retracement. That's called the golden ratio. That is the sweet spot for Fibonacci theory. What it means is if price sells off and then has a bounce, it's naturally going to want to move to the 618 level, which it did right here. Typically, if you bounce off that level and pause, you're usually going to go down and hit the 100% level, which is this one mark. So around $40 per ounce. So this is the very critical level for silver. Silver really needs to hold $60 or like $61 per ounce. If it can hold that, the long-term bullish picture is pointing to more or less $75 silver, which would bring silver up to about $175, a very big gain from where it is. But if silver breaks $61 or $60 per ounce, we're probably going to see a very quick drop down into this $40 mark, which is a 40% haircut from where it is. So, I mean, either way, there's a big opportunity. The question is right now, both gold and silver are giving mixed signals. Short term, the trend is down. Long term, the trend is up. We've got the dollar at a critical turning point. We've got wars coming to an end, or, the Strait of Hormuz getting figured out potentially. We've got a lot of things shifting right now. And so we just need to wait and see if silver can hold this level and start to move higher. It will generate us a new buy signal, and we can take advantage of the next leg higher. If silver breaks down, I am expecting it to drop very quickly to $40 per ounce, which I believe will be a steal. That is a point where both for gold and silver, I would be moving in and buying a bunch of physical metals. We did close out our metals at 111, way up here, and we're waiting for the market to reset. The market could trade sideways for many years. It could pull back substantially. Either way, I don't want to hold an asset that is at one point short-term overvalued. I'd rather get in later when it is starting to run again, or get in at a sharp discount and reload. That is the whole strategy I focus on around precious metals. So those are the scenarios. Gold and silver have the same scenarios. We're at a major turning point. The question is, do we get long again when it goes a little bit higher and generates a buy signal? Or do we pick it up at a killer deal when the dollar spikes up and we see precious metals get beat up and short-term oversold? I think we're in wild times. There's whatever rules are there, whatever has been the norm is no longer the norm. Volatility is here to stay. I think everything is starting to come across like, I think Trump kind of thrives on like unknowns and things just popping. And I think the whole new Fed coming out here, they're going to be a little bit more secretive of what they're doing, and they're changing things. It falls in line with kind of the way the world runs with Trump. Is just we don't know what's going to happen, and we keep seeing these huge swings. So there's a lot of uncertainty going on, and I think it's going to be here to stay. And it's just people just need to buckle up and get used to it. I mean, that's unfortunate, but it's what the Fed is going to do is just add a lot more uncertainty. And so we're going to probably start having bigger moves around the Fed because we don't know what they're going to say or how to interpret potentially the new language if they start bringing out new language and new ways to value things. I think, when there's wars and uncertainty, we tend to see metals do very well, and they have been. They've had a great many years, and they've really just had a blow off top this year. It's just a euphoric, huge move. It was just a huge sentiment move. A lot of people will throw out all kinds of reasons for it, but overall, if you go back and look at the charts, it's a typical price action, a huge sentiment move, and what happens after that is exactly what we're getting right now. It's not moving. Metals should be like moving differently. Instead, they're moving pretty much lockstep and barrel with the stock market. And that's because it's just been shaken. It just had a little bit of a bubble burst, and now it's trying to regroup, and that's exactly what it's doing. And eventually, it is going to be the ultimate safe haven play. I mean, I don't own any physical metals right now because we sold out of gold and silver right into the peak, and I feel really naked. It makes me feel much more exposed to currencies and all the BS that's going on in the world because I don't have physical gold. And to me, that's like the ultimate insurance plan. I buy physical metals to catch these big super cycle waves. I don't move in and out of them very frequently. And I'm looking forward to hopefully a sell off in metals so I can get them back into my portfolio and give me that little bit of insurance and peace of mind, because I really don't trust what's going on with the worlds and the currencies. I don't care if I have to buy at a higher price. I just don't want to hold it if it's going to crash 30, 40, 50%, or it goes sideways for a long time. Because we saw metals go sideways for, 10, 15 years, or a very long time there, a big stretch of window. And, if you can make 8 or 10 or 15% per year in equities and other plays, I'd much rather be earning money through that big weight and then get back into gold and silver, even if it's at a bit higher price when it's moving. So I think you make a very good point. I think it's important that a lot of people just need to have precious metals. I'm in tune with the markets enough that I can buy metals any day. I can move in. I have everything ready set up with, or I can buy ETFs, right? So it's very easy to at least quickly, a click of a button, I could take advantage of the precious metal space through ETFs if I need to. And then a few days later or a week later, I could just revert that into closing out and getting physical metals somewhere. So I'm not worried about being left behind. It just feels very weird because I've had metals forever, and they do provide that stability. And once you hold like bars, in your hand, there's something to it. It's like a true treasure.
Silver carries the sharper risk because it is sitting near a critical support area. If it can hold around $60 to $61, the long-term bullish picture remains alive, with room for a new buy signal and a stronger advance. If that level breaks, a fast drop toward $40 becomes possible, which would feel painful but could also create a rare discount for long-term buyers. The broader lesson is that volatility is now part of the landscape. Fed uncertainty, political surprises, war risk, currency pressure, and speculative bubbles are all creating larger swings across markets. Physical metals still matter because they act like insurance when trust in currencies and financial systems weakens. The better approach is not to panic over every pullback, but to separate short-term overvaluation from long-term protection. If gold and silver reset lower, the decline could become an opportunity to rebuild positions at better prices. If they hold support and turn higher, the next rally may arrive quickly, leaving hesitant buyers behind as safe haven demand returns with force. In wild markets, patience and levels matter more than fear, because the best opportunities often appear when the screen looks most uncomfortable before the broader trend resumes with real force. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.